Hello and welcome everybody to Capital Calls. And today I have a very guest, Andy from Finding Value. Thank you for coming on the show, my friend.
I really appreciate it. Thank you for having me on here.
Yeah. One thing before we get started, though, nothing in this video is financial advice. I am not a financial advisor, and neither is Andy. Please do your own due diligence. It's your money, your responsibility. With that said, Andy, tell us a little bit about yourself. Give us a little background of who you are and what kind of investments do you focus on?
Yeah, I'll just give you a little bit of a rundown of kind of myself, I guess. I'm an engineer by trade. I came out of school, was working. I was kind of, I'll just say I wasn't completely satisfied with my pay in relationship to how much effort I put in. So I wanted to earn more money after graduating college. So I looked around. I said, you know, what else can I do to earn more money? And that's really what was the gateway into me going into finance and investments and stuff like that. At least my own research and doing my own due diligence and stuff like that. So that was back in the mid 2000s. So in the mid 2000s, that's when I started getting interested in finance. I started looking into how can I make more money? How can I increase my cash flow, other, dividend income, stuff like that. So that's really what got me into the finance investment world, was just my own curiosity and me not being happy with the amount of money I was making during my 9-to-5 job. And eventually that morphed into many things over the years. And I created my YouTube channel in 2020. And that was from a person I was working with. They said, hey, check out this clip. What do you think of it? And I said, we are not in a housing bubble. There's no way. Do not believe this guy. And then he showed me another clip and another clip. And I'm like, these guys are not in a housing bubble in 2020. So that led me into the finance world of YouTube. So that's what led me there. We would talk a lot about finance at my 9-to-5 job with a lot of different people. And they're like, dude, you should start a channel. It seems like you know quite a bit about this stuff. And that's basically what I did. I created a channel based off of my own displeasure with other YouTubers that were sharing information or their opinions that I disagreed with. And that's what came about for my YouTube channel.
Yeah, so you have a fairly outside the box thesis that your channel is based off of. I know it is real estate, the real estate market, and how that ties into commodity prices. So can you give the audience a little bit of a primer on that?
Yeah, so I guess the thesis would be that demographics, so what demographics are is the a size of the population at a certain age comes into home buying years. They buy homes, which increases the credit, and that demographic creates a cycle, and it's called the real estate cycle. So that real estate cycle, based off of the size of the population interacting with the real estate market, determines the inflation in the system, because money is created through the loaning process, through our commercial banking system. 70% is residential real estate. So the credit expansion and contraction puts either higher rates of inflation or disinflation into the system, and that impacts interest rates. So when credit comes into the system, we see it as inflation. That inflation interacts with the bond market, and that bond market will sell bonds if the inflation rate is greater than the interest rate that's being paid, and interest rates will chase that inflation higher over time, which then has an impact on the pricing of all assets in the world, as weird as that sounds. So in my opinion, the way the demographic or the population coming into home buying years impacts inflation, which then impacts interest rates, which then impacts the pricing of all assets. So the demographics impacts the pricing of assets.
And That's in regards to the US real estate market. So you're saying that that has widespread impact across the world when it comes to commodity supplies?
Yeah, so since commodities are priced in dollars and the United States impacts the value of the dollar, therefore the demographic in the reserve currency or whatever commodities are traded in, which is dollars, will have an impact on the pricing of those commodities. And that's kind of the general overarching sweeping, all commodities go up, all commodities go down from that credit expansion basis. There can be instances where a commodity, like a singular commodity, has a very, we'll call it a big deficit in their supply demand of that particular commodity, which will also impact the price. But these big credit cycles that are created from the real estate cycle is what impacts the overall pricing of all commodities. So really what it's doing is it's changing the market conditions that assets are being priced under, and then money flows different under those market conditions. So in a low inflation, low interest rate environment, which we call as a recovery phase of real estate, that is we'll call it a hotbed for technology stocks and regular stocks that are consumers of commodities, and we'll say consumer of the wants in the spending. So people want to spend on Netflix and technology and new iPhones and whatever else. We'll call it the wants get all the money there, the speculation and stuff. As the credit cycle goes on, or the real estate cycle, you see a demand supply tightening in the housing market. So prices of houses start to go up, inventories start to go down, and that tightness shifts money differently in the market because you'll start to get more inflation from new homes being built and inflation from that credit expansion of those new loans against those new homes that are created in the commercial banking system. And what happens is money starts to flow differently. On the consumer side, money starts to flow towards higher home costs, higher energy prices, higher whatever it is in the market. That money starts flowing to those things, and it starts leaving technology in some of those other areas. So what you see kind of in the market as this cycle progresses, you'll see at the bottom of the market when everything kind of blown out from a recession, we'll call it from a housing market recession, we get a recovery phase where certain technology stocks, all these more speculative companies on the tech side get all the money. It'll slowly work its way through as a demographic comes into home buying years. It'll work more towards real estate, more towards oil and other commodities, because as inflation starts coming into the system, interest rates start coming up, the bond market money starts leaving bonds, and then eventually it'll start to hit the technology sector as well as interest rates go up and the fair value of all these speculative stocks start to go down as their net present value calculations decline with higher interest rates and those calculations with higher interest rates. So it's hard to, it's a very big cycle. It's kind of hard to explain. I'm trying to do everything off the top of my head here. The easiest thing to I guess to take away, if you were to make it really, really easy, is money flows different based off the real estate cycle. In expansionary phases where you see a lot of new homes being built and inventories are very low. And when we're in that phase, commodities go ballistic because money exits bonds, it exits stocks and goes into commodities during that time of the cycle, that credit cycle.
So I've been hearing that we are on the cusp of a real estate crash for over 3 years now. Are we on the cusp of a real estate crash? Why or why not? And how would that impact your thesis moving forward?
Well, yeah, the thesis is that's exactly what you want to watch is the real estate market. In my opinion, which is going to differ from a lot of other people's, and maybe it's similar to very few, seems like it's very few. I don't think we're on the cusp of a real estate market crash. And when I mean by cusp, I don't think we're within a year of it or even 2 years of it. The reason I think that is that we have such low inventory levels. The inventory levels are very low, and we're in an underbuilt state. So if you look at the housing market in terms of family gatherings in relationship to how many homes are out there to purchase, the estimates have it between 3 and 6 million shortfall in that housing market for an underbuilt scenario. If we were in an underbuilt scenario, what we would see and what we would observe is if you were to lower interest rates, you would have a frenzy in the real estate market. You'd see prices just go ballistic. And that's exactly what we saw in 2020 and 2021. They lowered interest rates. We had all the demand out there, and we had a feeding frenzy in the real estate market that pushed prices up dramatically. So we know that we're in an underbuilt scenario because the buying pressure existed when those rates just went down a little bit. And what Powell's doing is he's trying to slow it all down. He's like, crap, there's too many buyers out there. Let's raise rates, yank it way up. We need to slow everything down. And that's exactly what he did. So what he did is he yanked those rates up, which impacted the affordability of the housing market and the real estate market. And now everything's going really slow. The demand is still there. It's just the affordability is a lot less. The inventory is not coming onto the market, and we're building new homes, but it's not at an extravagant level. It's at a 1.4 million homes. So it's not a ton of supply, and our inventories they're not increasing really. They're just staying flat at a very low level. If we're at the end of this cycle, and in my opinion, if we are at the end of it, we would see 10 months of inventory, 8 to 10 months to 12 months of inventory, somewhere in that range. We're sitting down here at 2 or 3 months. So there's a big disconnect on perhaps the opinions of a lot of people of where we are in this real estate cycle. They think we're much later. They're just using price as the indication of a potential crash. They're using some cities that are probably being exited, like San Francisco, New York, some of these, we'll call it cities that a lot of people are leaving. So they're using that as maybe perhaps their data. But at the end of each one of these cycles, what we've observed in history has been 8 to 10 months, 12 months of inventory. We get a peak in our inventory. We get a peak in our housing starts. They start to decline. Inventory starts to go up. We also see construction employees get laid off, and we are at all-time highs for those. And it takes time. This isn't going to be quick. So we're going to hit some sort of top in construction at some point, whenever that point is. And then we're probably going to go sideways for 5 or 6 months, and then we'll start to decline. And then I would say from that peak, we probably have a good 6 months to year of it declining before we actually get a recession, at least from the real estate market. So I think where a lot of people have it wrong, and this is just my opinion of what their opinions are, so who knows if this is 100% right, but I think that they think that a recession impacts the housing market, and I think they have it backwards. I think the housing market is what's going to cause most of these recessions. We can have a slowdown, we can have a recession that is not driven by the housing market from higher interest rates cleansing out a bunch of crap in the system from having a low interest rate environment for so long. I don't think it's going to be a gigantic deleveraging type event like it was in 2008, which was a real estate driven market crash. The early 30s was a real estate driven market crash. It was a deleveraging, defaults, credit destruction event. I think it's going to be more like the 2000, 2001 pullback that we got from the NASDAQ bubble. I think we're in the same exact spot as the NASDAQ bubble as we are today. High valuation prices in tech stocks and S&P 500, high valuations for bonds, obviously, because we went from a very high interest rate in 1980 to a very low interest rate in 2020. a 40-year decline in interest rates. And now that's changing where we've broken to the upside of interest rates, which is a pretty profound impact on the pricing of assets. So I think that we're early in the real estate cycle, or mid-cycle, early in the expansion phase of real estate is what I should say. And I don't think that we're going to have a blowout crash to the downside. If I'm wrong, you would see inventories shoot up, and you would see construction employees and all that stuff start to decline, which we haven't seen yet. So we're still, I think, a few years away. And if you do see those, those are indications that it could be, the housing market could be falling apart.
Yeah. And to add fuel to the fire, I don't think you mentioned this, but you do have the millennials coming into home buying years, as you mentioned on your channel, over and over again. That's your biggest cohort, I think, ever, right? I think the millennial generation is bigger than the boomer generation. So you have that group, that cohort of people coming in, buying homes. I'm one of them. I don't know if you are. You might be a late stage or early stage millennial.
I'm the oldest millennial.
Oldest millennial. There you go.
Yep.
So, and on top of that, the rate hikes. I interviewed Doomber a couple episodes back, and he said something really interesting when I tried to tease and answer at him in terms of how rate hikes and how just rate hikes, rate cuts impact the market as a whole. And he gave a really interesting answer. He said that the rate hikes are actually making inflation worse. So it's kind of counterintuitive. You would think rate hikes would kind of be a downward pressure on demand, but rate hikes make investing or CapEx spending on capital intensive markets like commodity markets a lot more difficult. It costs $1 billion to build a rig. Like these mines cost a ton of money. Finance is a lot tougher today than it was 2 years ago. So that provides a downward pressure. That provides more pressure on supply. More pressure on supply implies increased prices to build a house moving forward as well. So it's not, we've got to be able to see beyond our nose with, beyond first order effects, to your point there.
Yeah. So what I would say there is interest rates are a function of the market condition. They're not a leading indicator, they're a lagging indicator.
Right.
So the demographic comes in, they go into this home buying years, and then the interest rate comes chasing higher. And there could be, the interest rate could expose problems in the system. So the problems in the system could be a supply side problem. So if that credit comes into the system, what it does is inflation is basically credit being created at a faster pace than gross domestic product. And it puts everything into a shortage. So you've got more money chasing fewer goods. That is AKA inflation.
Yep.
And then what it does is it exposes the weaknesses in the system. It says, where are you short? And what happens is if you're short in energy, which is basically the fundamental basis of GDP, you're going to have some sort of problem with, potentially could have some problem with inflation, because you can't grow your GDP if you've got energy problems in a system alongside that credit expansion or the inflation in the system. So when the credit expands, it throws it into a shortage. And if you have a shortage of energy, you could have a problem with an imbalance of money credit creation in relationship to GDP. And that's really what inflation is. I think we've got major problems on the energy side, like major. And there's going to be wonderful opportunities for investment on the energy side, because I think we're getting close to a worldwide, we'll call it the pumping capacity of oil. I think we're getting closer and closer to it. I don't know the exact, peak. I don't know how long that peak and what the peak looks like, but I think we're getting closer, and it's going to be harder to pump more and more out of the ground. I think also on the supply side of many metals that the ore grades are declining, the deposits are deeper, and it takes more energy to extract those metals out of the ground. So you combine the underinvestment in energy and the difficulty to get, we'll call it, to find very large reservoirs of oil pair that with the copper, we'll call the depletion of a lot of these base metals, the depletion, or say the decline in ore grades, the exponential energy input costs to extract those decline in ore grades, and you get this weird mixture of what I think is going to be a very inflationary environment, because it's just going to cost a lot more money to get everything out of the ground that people want and need.
Yeah. And so you're saying, so you alluded to the fact that you think that we're somewhere in the dot-com bubble burst in terms of where we are in this current commodity super cycle. So we haven't even really gone to this 300% increase in the commodity index that we saw over the course of 2 years or whatever. That's just kind of like the pre-show, is what you're saying.
So that's from the credit side. So I'll try to break this up. We've got a credit side, and then we've got the supply side.
Yep.
The credit side is that real estate cycle boom. That's the credit creation. They also created credit through stimulus. So I think that first initial surge was from the credit side. It was from a bunch of homes being sold, a bunch of stimulus that came into the system, and kind of flooded the market and put everything into a shortage. That's why there were shortages everywhere. It's a shortage because you put 40% more money in the system and created, quote, demand, at least credit demand. So all that credit came into the system. It caused inflation. Money rotated differently during that time frame, and those assets went up. What I think is still to come is supply side problems. Like the big boy move is still ahead of us. So if we have what happens is the Federal Reserve, they can't have the credit side kicking out credit at the same time that you have a supply side problem. You're going to get massive inflation. Yep. In the 1970s, that's exactly what happened. We had peak oil in the United States. We had the baby boomers come into home buying years. Home prices went ballistic. Credit expansion threw all this money into the system from that big real estate cycle boom. The people were spending money. They were having kids. They were basically buying a bunch of stuff as this credit was just flinging into the system. At the same time, we had a problem with the energy side of the system. So we had a supply side problem in the United States. So that we saw shortages of oil and gasoline and all these different things during that time frame, and inflation went ballistic during that time frame. There was also worries about currencies at that time as well, and that's why gold went up. I can't remember the exact amount, 25 or 27 times, and silver went up like 50 times in that time frame. Because people were worried about the currency. So the rates went up, not because the Federal Reserve, had some sort of foresight to put it up to that level. The market forced it. And then they left it up there. That's what the market wanted. And then that demographic came through, and the demographic basically ceased to exist to put that inflationary pressure, and everything came back down. But we also could grow into the entire world's production capacity of oil and other reserves of base metals and everything into the entire world at that time. So yes, it was a localized event in the 1970s, which was a prelude to what I think is today coming. So the 70s was just America, and it was contained roughly to America, but we had a way out because we could import oil, expand into world's production capacity. It was really no big deal. Now it's the whole world. And we are going to see what the world can produce in terms of oil. We're going to see what the world can produce in terms of a lot of these different commodities. And if we have the credit side if the credit side continues to kick out money, and it may have to in order for the money system to survive. Think of it as the design of a lot of these currencies. They must grow continually at an exponential pace at some percent in order to survive. The problem is, if you grow at an exponential pace, your currency is going up, your GDP gets stuck with your commodity supply side problems, and you'll get an imbalance of credit creation in relationship to GDP getting stuck. And this can get stuck for whatever reason. It could be base metals have problems expanding. It could be energy. Energy is the basis of basically all mining in the world. So mining is a derivative of energy, and energy is kind of I'll say the master commodity. It provides the abilities for everything to be made in society, for food, for fertilizer, for whatever it is. So if you have a problem with energy and the system must grow its credit, you're going to have an imbalance at some point where the system is going to get very inflationary. So the only thing that they can do short term, I think, is raise interest rates and try to kill the demand for the credit creation in the system, given that demographic wanting to come in and buy homes. I don't know how they're going to solve this, because they're going to get in a bad situation where they're painted into the corner and they're like, how do we get out of this? Because if they hold rates real high for a long time, you're going to have a lot of deficit spending that's going to occur from the interest payments on the debt that we have already. If they don't keep the rates high and they lower those rates back down, you're going to get inflation from the real estate market, because the demographics there to buy a bunch of homes and create credit to buy those new homes. So the Federal Reserve's in a difficult spot where I don't think they can get out of it. They're going to have to choose one way or the other. And I don't know what they're going to choose. They're probably going to choose to save the bond market at some point, and they're just going to destroy the currency. That seems like the path that most countries take in history. So I think they're in a difficult spot, and this could be worldwide. If we see a worldwide crunch in oil or just energy in general, which I think we are, what you're going to see is basically what you saw in Europe, which is massive inflation. And now they're trying to get it all under control, but I don't know how they're going to do that in a longer term basis. I mean, basically you're at the point, and maybe they're looking at trying to do whatever. I don't know what they're trying to do there, depopulation or whatever. But if you have a population that wants to grow and get larger, and you've got more people coming into home buying years, it's going to be credit expansion.
Or you just make them poor. Yeah, or you just make them poor. Poor people use less energy.
Yeah, but what's tough there is everybody doesn't want to be poor.
Yeah.
So they all strive to basically use more energy. Energy is I guess that's wealth. So anything and everything that you do is going to require energy. You could say, oh, I don't want to use energy. I'll put my money in the bank, and then the bank loans it to another, company. They grow the company, and that's using energy. It's like, how do you not use energy in the system that we currently have? So I think any way you look at it, you're going to be using some sort of energy. You eat more energy. You go on more trips, energy. You buy another car, it's made of energy. It's all energy, anywhere we look.
Yeah, and another thing to consider, though, even though we have raised interest rates to 500 basis points Fed funds rate down from up from the zero bound, that's still the actual inflation rate, most likely, if you measure inflation like we did in the 1980s. We've had many adjustments to the actual inflation methodology. So they can say it's 4.9%, 4.8, whatever it is, I don't remember. But if you actually measure it along the same lines as we used to 30 years ago, Shatterstats gives a reading of that number. It's essentially a doubling, a 2x of what we currently have. So even though we've raised interest rates 500 basis points, real interest rates are still in the negative territory. So they can't, I don't really foresee them raising interest rates another 500 basis points to meet the actual inflation target and actually, be at parity with inflation, especially in view of the fact that they're already talking about pausing. In the rate hikes that they are talking about, these are all just a couple 25 basis point rate hikes. And if they keep raising inflation, to your point, the debt burden becomes too large to service. And then you've got, a collapse worldwide as a result. So it's, you're damned if you do, you're damned if you don't.
Agreed.
Cool. So sounds like you're in commodities. This is what we kind of cover here on this channel as well, for largely the same reasons that you do, just because due to the shortages, the underinvestment over the last 10, 15 years or so since the last commodity bull market. These things are cyclical, right? They go from being overinvested into, sorry, being underinvested into being overinvested in. And then you just have an oversupply, a glut in the market, it drives the prices down for a decade or more, whatever it is. And you anticipate more investment coming in during that downtime to really filter out all the bad companies, the Johnny come latelys during the last bull market. But what's so special in this case is oil, fossil fuel capex never took off in the 2010s as it should have taken off, as it did in prior commodity bull market. So we're still left with dried up capex, relatively speaking, today to be unable to meet the commodity demand that we require. How do you? I know you on your channel, you guys look at technical analysis. How do you evaluate sectors? How do you evaluate companies? How do you evaluate, what's overvalued versus undervalued? I know you use your ratios. Can you go a little deeper on that?
Yeah, so I call it the three pillars. You may have, if you've been watching, maybe you know about it. It's ratio analysis, market conditions, and technical analysis. And what that is ratios tell you it's an asset priced against an asset, and then you compare it to history. And you get a chart of these two assets. We'll call it a valuation channel over time. And whenever you find undervaluation scenarios where you price, I'm going to give just an example, the S&P 500 versus gold, you'll get these anomalies in history, or these movements in history that go up and down against each other, asset one, asset two, and they just go up and down. You want to look for those undervaluations in the markets where that asset is very cheap against other assets. And right now, what we're seeing from a ratio perspective is that we're seeing that the financial assets are expensive. The financial assets are bonds and stocks, and they're cheap against commodities and precious metals. And what that is telling us is it's telling us a little bit about the market conditions. Market conditions are what prices assets. It's what changes the movements in the ratios. So right now, someone would ask, well, why are financial assets expensive and why are commodities cheap? And why is our ratio telling us and showing us that there's a large disparity between the valuations compared to history in these two asset classes? Well, we've had a 40-year decline in interest rates, and that 40-year decline from 1980 to 2020, which also coincided with a smaller cohort of population, which was Gen X. The growth rate wasn't as big as the millennials or the baby boomers. So we came in decline in those interest rates all the way to 2020. It's much like Japan. Japan's demographics is declining. Their population's actually declining, and so is their housing market. So we had this cooling off period, so to speak, in terms of inflation. And there was other driving factors behind it as well, in terms of commodities and outsourcing employment and stuff like that. But it went all the way down to 2020, and everyone piled into financial assets because the interest rates were in a 40-year decline. That's what the ratios are telling us. And what we recently saw in 2020, 2021, 2022 is we saw the 10-year yield and 30-year yield break out of those downtrend levels. That's a huge change in the market. It's a paradigm shift is what I call it. And those interest rates are going to cause a rotation of money to move differently. That's a part of the market condition, and it will change the valuation of those ratios over time. And money's going to flow away from financial assets and towards real things like commodities and precious metals. The reason it's going to do that is based off of the population demographic in the world, and in America too. If we have commodities still priced in dollars, people are going to spend more money on homes because we're going to have a shortage of homes. They're going to spend more money on food. They're going to have kids. They're going to spend more money on energy. And the money is going to rotate away from financial assets towards these real things because, one, there's an underinvestment there, and two, they're going to become more expensive, and it's going to take a larger portion of their, we'll call it their finances, to go towards it. That's going to rotate money away from technology and some of these other companies that are, quote, once in the system. And that money's going to go towards needs of housing, needs of energy, needs of food, needs of all these different things. And with the supply side of commodities looking so dire, you're going to also see a lot of money shift to where the problems are in the markets. And the problems are all over in commodities from underinvestment. So it's a combination of those two things. So we've got the ratio side that's showing us the imbalance in the market. We can see where the money is at, which is the financial sector and stocks and bonds. It's going to rotate over to commodities. It's already broken the downtrend in that ratio. It's starting to come up for commodities and the commodity outperformance of stocks. We know that the market conditions have changed because the interest rates have broken their long-term 40-year downtrend marks in the 10-year and 30-year. And then I think precious metals could do very well, because if we have a energy constraint in the system, doesn't matter what it is, underinvestment, we're hitting a plateau or peak in cheap energy, so to speak. I think that money could really rotate at precious metals if people get scared of the financial system. The financial system scared being with bonds, because when interest rates go up, bond prices go down. And when bond prices go down, it's going to put financial pain in those bondholders to sell. And it's going to cause money to rotate out and go chase performance. And the performance will be in precious metals, and the performance will be in commodities, because that's where the undersupply is in the market. That's where the problems are. And money flows from non-problems to problems in the market to be solved over time. So that's what I see in the market. I use the valuation of ratios. Market conditions is tied to interest rates. And then I just use technical analysis to validate that it's occurring in a non-biased way. I don't use people on YouTube to tell me, like XYZ. I don't use experts. I just use charts and the unbiased opinions of what the data is telling me.
The data, yeah.
Yep. And then you use patterns. So pattern recognition is basically how humans are interacting with each other and creating these patterns, which basically repeats over time. They create these patterns down, basic downtrend lines, bottoming patterns. I've got names for them and stuff, but double bottom patterns, inverted head and shoulders, all these different patterns that humans create when they trade with each other. So we're using the combination of the valuations with ratios, the market conditions, and then the validating that with the human herd mentality that spits out these patterns that we can say, yeah, they're behaving in a way and changing towards these market conditions, and we're validating that through the patterns.
Yeah, and to tie in what you just said about precious metals to something else you said earlier in the interview, the way things are setting up now, it's going to be a lot more difficult to pull these metals out of the ground. So, as energy becomes more constricted, we're going to have to make choices on what we prioritize from pulling out of the ground. Copper, we pull that out of the ground, we get electricity. Silver, we get electronics, but gold doesn't really have much utility aside from jewelry. So we may come to a point where we look at the amount of oil, we look at the amount of energy that it takes to mine this stuff and say, it's just not worth mining it. And then in your stock to flow ratio, it's like, it just goes up because there's no flow coming in anymore. And that's another tailwind for precious metals, gold in particular. So good point there. And you also touched on the fact that the charts tell you, the charts are indicative. They are a reflection of mob psychology. So, like for example, the hammer pattern that you sometimes reference in your videos, when whether it be on a daily, weekly, monthly basis, when you hit a certain price point below your opening cost, but then it rebounds all the way up and closes above that, that's essentially telling you a story that the buyer, that the sellers took, a certain asset all the way down, but then the buyers just simply overpowered it to the upside. So I feel like it's really important to think chart in terms of buyers and sellers, and the trying to break equilibrium between those two. Do you have any other like examples of mob psychology showing up on the charts?
Oh yeah, they're all over the place. So what I try to do is I don't want to look at just one sector. So I know some people, they might be interested in one sector, right? So they get very interested in one sector, they look at it, and that's all they look at. What I look at is the entire thing. So I want to look at all the commodities, all these different sectors, to see that they're all exhibiting the same herd mentality that you're seeing. And if you're looking at the psychology, if you want me to go kind of into the psychology of how these things are traded, all we're looking for are buying and selling areas where you find support and resistance. So what you described was you were at a support level where you come down, and let's say you're in a big downtrend, it's coming down, price is coming down, you've got good buying pressure here. You don't know that, we'll have to see it in the charts. And it comes down, and then all of a sudden it reverses really hard, and it starts to come to what I call a dead period, where it just goes sideways. What that means is that the buyers are equaling the sellers, the buying pressure and the selling pressure. And it's coming to a level that's cheap enough where buyers are like, you know what, I want to get a piece of this at this price. And that's really what we are seeing, are these patterns are telling us where the support levels are at, where the resistance levels are at, where the buying pressure's at, where the selling pressure's at. And then the way they bounce and move creates a pattern, basically telling us where these levels are at the most basic level of understanding. And then we use those patterns to say, okay, I know the support levels down here, we're done going down. Now we're looking for a potential reversal. And then if you can see that and pair that up, we're looking for an alignment in the markets where the technicals align with the valuation metric, that is those ratios we're looking at. And then we want the market conditions to swing favorable for those ratios to swing from, let's say this is overvalued, going and swinging all the way back to where this asset's overvalued. So we're in commodities here, which are undervalued. Bonds are overpriced with stocks. And we're going to see these ratios reverse because of the market conditions that they're being subject to, the humans are being subject to. So if humans are subject to different market conditions, they behave differently. So if you put a bunch of inflation into the system, the buyers are going, the humans are going to say, which are potential buyers of stock, they're going to say, I don't want to own tech stocks. I'm getting killed on energy. I'm getting killed trying to buy homes. So they start investing more money in homes and energy. When they're subject to these high inflation rates, and they see it and live in it. So what we're doing is we're changing the conditions that the humans are living under in their world, and that causes them to shift spending behaviors and investing behaviors. And then everyone starts to basically jump on that train. And once you hit a certain threshold of certain individuals kind of moving and changing their behavior and patterns, the whole herd starts to shift. So we're seeing that, one, in the buying and selling pressure of the charts, but we're also seeing that on the consumer side and how their spending habits are changing. If you notice in the markets, we're seeing a lot of layoffs in the tech sectors. And that's an indication of kind of where we're at in the cycle. Generally, that's kind of 2000, 2001, you get this tech kind of rollover. And we've seen the stocks roll over in tech. We're starting to see unemployment kick up in technology, and that's all part of the cycle. If you map this out of the last cycle, where you look at the technology stocks in 2000, 2001, 2002, you look at commodities, you look at all that stuff, you had a commodity market bottom in 99, 98, 99, 2000, it bottomed and started coming up. The technology sector topped, started coming back down. And that's basically where we are at today. We've got the commodity sector that's starting to come up, and then we're rolling over a little bit with the technology sector coming back down. And then eventually what you'll see is you're going to see the technology sector continue to go lower or sideways. And then you're going to see our commodities continue to go up. at some point. You'll see it break again. And that money is going to rotate differently in the system because the people in the system are going to behave differently. And that behavior is going to change from both aspects. It's from the investment side and from the consumer side and how they spend their money. And we're seeing that happen right now. And if you talk to people and you ask them about inflation, you ask them about certain things, and you're going to see more and more people get more concerned about inflation. They're going to start to want higher pay at work. They're going to ask for bigger raises. It's going to change the behaviors. And eventually it's going to keep pushing, I think, to some degree in that inflationary direction. But it doesn't mean that inflation just goes straight up. It's not a straight line. You're going to get pullbacks in this thing. It's going to get everybody confused. People are going to get frustrated with their trades, perhaps, because commodities are incredibly volatile. And I think a lot of, we'll call it the retail sector, is going to struggle with these pullbacks because the pullbacks are pretty big. They're 40, 50, 60% in a lot of these companies. And timing the short term can be incredibly difficult. That's something I don't like to do. I'm not in there trying to trade in and out. I just ride this thing from top to bottom. When this money does rotate, the valuation extremes on this cycle are very extreme. So we were at extreme levels to the downside for a lot of these different commodities. Oil in particular went negative, which is basically unheard of in 2020. So coming from such low valuations, that causes problems on the commodity side because no one invests when you've got prices that are negative or very low. I think that it's going to go to extreme levels in the opposite direction at some point, and it's going to be at levels that if I name the prices off here, people are going to call me crazy. Because the value, a 40-year decline, the underinvestment is so extreme, and I think that we're coming to supply side problems with a lot of base metals and other types of metals that in order to get those out of the ground, you're going to use copious amounts of energy. So we're going to have to come up with completely different solutions than what we were using in the past, in the future, to mine a lot of this stuff out of the ground at these lower ore grade levels.
Yeah. So lots of things to unpack there. Number one, when it comes to, your answer to technical analysis and it's kind of mapping to human psychology, a lot of people tend to think that technical analysis should be like 100%, like 1,000, like your call should be like 1,000, batting average. These things are only telling us probabilities, in a sense that, you're an engineer. I have a math and stats background. I analytic work, but what we have something in probability theory called expected value, essentially a fancy word for average. And you want to play the averages. You want to play it in such a way that your expected value over an iterative number of times is taking you upwards. It's sort of like the house always wins. The house is like a 51% chance of winning, about 49%. After enough trials, the house is always going to, they're going to make a profit. But technical analysis, human psychology, like your reading of it, if you do it over and over again, you're more likely, you're going to come out ahead if you do it, the correct way. That doesn't mean you're going to get it right every single time, because I see a lot of people they point out like, oh, well, you said, we're about to break out, but it didn't. Blah, blah, blah. Well, it's not going to be right all the time. It's just going to be, it just has a slightly better chance of being right than being wrong. And that's the way I see it, at least. And I'm in your camp. I'm in this stuff for the long run.
I can comment on that. So
yeah.
in the short term, you're purely charting emotions and the way that humans are feeling about the market, so to speak. So in the short term, just like everyone else, if you're listening to this, you're like, well, it may take you a month or 2 or 3 months to decide to buy a certain car, right? You got to do your research, you got to do whatever. And there may be times where you're like, yeah, I really want to buy the car. And that's kind of like the market of you voting, yeah, I really want to own this stock. And then all of a sudden you buy it and you're like, no, I don't want to own it. Get me out of it. And then you change your mind again and you buy it again. And then you're like, yeah, no, I don't want to be in it. It's that like changing of your opinion in the short term of you wanting to buy some car or wanting to buy something and you're changing your mind back and forth. That's the market in the short term. It's changing its mind. It doesn't know what it really wants. News comes out. It basically impacts the decision of a bunch of buyers in the market. But in the long term, what I'm doing is I'm saying, okay, this person needs to travel from A to B. I'm just going to bet that this person is going to buy a car. Like,
Yeah.
That's it. I don't care what kind it is. I'm betting that they're going to buy a car. And in the short term, they might be battling back and forth if they're going to buy it this month, next month, or the month after. We don't know which month they're going to buy it. We just know that they need transportation. And maybe in the short term, they put up with some, some inconveniences and take the bus for a little bit and save more money and then buy the car a year from now. But I still win in a year if they potentially buy a car. So I think that's kind of what the markets are. In the long term, we can kind of see how the fundamentals are positioning, because the long term, the fundamentals drive everything in the long term. In the short term, anything can drive the market. Anything. It could be this piece of news that came out, whether it's legit news or not legit news, it's going to move the market in a certain direction. So what I've found, and I know this may go counter to some other people, because other people say, well, we know the direction with a higher degree of certainty, the path it will take in the short term. I would say that the short term is completely unknown, and that the long term is really where you want to be. And you want this alignment of valuation, technical analysis, and market conditions to get in these alignments where everything is basically in your favor to increase the probability of your success. I mean, that's about all you can do as an investor. You want to increase the probability of your success for something to occur over a period of time. Short term, though, I mean, anything can impact it. You could have an earthquake tomorrow and just devastates an entire area. But in the long run, people are still going to need energy, and they're still going to need cars, and they're still going to need certain things. So in the long run, yeah, that's still going to happen if there's more population or higher growth or more adoption of a certain thing or technology. So I think longer term, it's more reliable, but we just don't know the path. And the path is where I think everybody wants to try to get right. They're trying to trade the short term, and I just think it's really hard to be successful on just doing one thing, which is technical analysis and using human behavior to determine the path of whatever it is. You increase the success of your probability. The probability of your success increases infinitely when you tie in many things and they're all in alignment. So if you're looking at low inventory levels and you don't know, so if someone knows there's low inventory levels, we know that they're building a bunch of things in the future to consume even more of this certain commodity or product, and the technicals align with it, you have a higher degree of success than someone who knows nothing but just the technicals. So that's why I consider myself to be a hybrid, because I look at all of the fundamental stuff behind it and the technicals. I want an alignment to increase the probability of success. These other guys or girls, they look at just the patterns, and some of these patterns can get you twisted backwards. It may look like a head and shoulders top in the short term, which isn't a head and shoulders top. It could be a lead-in pattern that we've seen before. I call it fractals. It's a fractal of the DNA of a stock moving over time over big bull markets. And in the beginning of these bull markets, they look like head and shoulders, but they actually rip to the upside. And it gets everybody, I'll say, tripped up, because they're just looking at the pattern itself, not the whole big picture view of the fundamentals and technicals tied together with the valuations. So that's where I may disagree a little bit with some people, because they'll just look at it and say, oh, this is definitely crashing. You're like, really? It's going to crash when you have no inventory? Like, that's really hard to do, especially since we've never seen that in history before. I mean, that's like, there's got to be some give there. So, I haven't seen a housing market crash with inventory levels at 2 months. It's never happened before, but this time it's different. That's what everyone's telling me. It's different. We've got prices going down, therefore it must crash. And maybe we see softness in the short term maybe Powell's going to raise these rates to a level that does impact the affordability for some people, and the markets need to adjust or needs an adjustment period because the rate of increase was so dramatic in such a short period of time. I don't have all the answers, but some of these guys, they're throwing out some pretty big predictions, and I don't like to throw out predictions necessarily, but they're throwing out some pretty heavy predictions, and I don't see the inventory and the markets and the data supporting their predictions.
Yeah, and what I've come to realize is that a lot of these gurus and big shots in the macro world on FinTwit, they get one major event right, and they just write off that major event. Michael Burry, he's been calling for a crash now for like 3 or 4 years, still hasn't happened. So it's like you get lucky, whether or not it's luck, I don't know, but you nail one and you just coast off of that single reputation just because it was so monumentous. And that's what I see with a lot of the gurus out there. So I'm glad you you pointed that out. And to your point of these other people out there who just look at the technical analysis by itself, that's a univariate analysis. Univariate analysis are what we call naive, right? You're assuming that the only thing that matters is to pass us through time, nothing else. There's no exogenous factors that can come to move this thing up or down. So the way you're describing, you look from, it sounds like you're taking the technical analysis as confirmatory to the fundamentals. You come up with a fundamental thesis, and a technical analysis just simply confirmed that. Is that right?
100% right there. Because fundamental analysis, I don't think it's a good strategy to just use that. If I just looked at charts and charts alone, and all I knew was just technical analysis, I think that my probability of success would be pretty bad. If I looked at it from the perspective of, if someone gave me like the background, they said you're in an environment where you've got a shortage of homes, you've got an inflationary environment, and you've got, it looks like a bottoming pattern that's coming in oil companies. I'm like, go long as hell. Like that's the time to load up. And if you've got a gold to oil ratio that's at 100 to 1, that's when you want to bet the house. You bet the house when it's like that. That's the market condition. And if I'm wrong on the technicals, I'm right on the valuation. And I just wait. I use time to hedge myself. And what most people do is they don't hedge themselves with time. They just say, oh, it didn't work in 3 days, I'm going to sell. It's like 3 days. You can't do anything in 3 days. You can barely, like set a dentist schedule for 3 days. I mean, it's like, come on. So I think a lot of younger investors, they are way too impatient. You got to figure out, it's not you changing the markets. The markets need to change yourself to what the markets will bear and the timeframes that the markets are going to allow you to make money in. You have to be a student of the markets. It's not your wants and desires that are going to be reflected in your strategy and trading, because your wants and desires, if it's too short of a time frame, you just won't make money. Like, it's not the right place for you to be. A lot of these things, you got to get the time frames right. If you don't have the right time frame, you will get chewed up, spit out of these markets, and you're going to be very frustrated with the markets. I see a lot of people, they'll buy things, they chase something into a sector, they're down 20, 30, 40%, and they're getting very impatient. They don't like the sector anymore because they haven't had success within the time frame that they made up off the top of their head. It's been 6 months. It's like, well, I mean, 6 months isn't that long in the investment world. If something's cheap and it gets cheaper, and everything still looks good from a fundamental perspective, and the technicals look kind of crappy in the short term, you just hold on and you wait. And then you wait. And when the technicals firm up, that's when you give it another large shot of injection of investment, and then let it ride. So that's the way that I invest. That's the way that I view it. And I think a lot of people, they think they can time the short term. And I'm just going to tell you, it's going to be a tough lesson for them.
I think what happens is that people so we can control things on a short-term basis on our day-to-day lives.
Mhm.
Long-term stuff, I can't predict where what state or country I'll be 5 years from now. That's unpredictable. So we juxtapose that viewpoint onto our investment analysis, but it's not accurate because your thesis where you can get a big edge is just by having patience and a long time horizon and just the ability to hold on to hold on to a position. Now that in and of itself is a difficult proposition. Just being able to hold on, because life can throw many different things at you where you may need to liquidate at any given point in time. But if you're able to do it, that can be one of your biggest edges right there. So, what are some of your edges that you would say as an investor? What kind of gives you an advantage above all else, all the other investors? I know you probably already alluded to a lot of them through the interview.
Yeah, I would say, one thing that you can look at that I think some people may or may not do, I think ratios give you a gigantic edge on where the value is in the market. And then you can see, if you monitor the ratios, it'll tell you when things start to move against each other. That is a gigantic edge if people are not using those at all. Because when certain assets outperform other assets, you can tell what kind of market condition you're in. For example, the copper to gold ratio. Copper is a kind of an economic indicator. Gold is a fear indicator. And right now, we've got the copper to gold ratio going down, which means fear is outweighing the economic strength. So that is something where someone could undeniably say, look, there's more fear in this market than there is economic strength at this current time. And it's starting to deteriorate to some degree. And you can use those things that will give you an edge over other investors. I also think I'm incredibly patient, and it's hard to convince me otherwise. So what I can do is I can isolate my ideas from other people's ideas, and they don't leak into my ideas necessarily. They really have to have a compelling case to have me change my outlook or opinion. So when someone brings one piece of data, I'm like, well, let's stack this data up and see 30, 40 other pieces of data. So I think one other thing that I'm better at or gives me an edge is I'm good at deciphering data in an objective manner and use lots of data to come up with a conclusion. A lot of people look at one thing. They may look at the Case-Shiller home price index and have it going down a little bit, and they just say, oh, it's a crash. And they just go to that. It's like, well, you should probably link this up with inventory, days on the market, all these different other pieces of information. If they don't link up, then maybe it's just a short-term little pullback in a longer-term move to the upside. I also do a lot of fractal analysis. Fractals are patterns that are created in the markets, and you can see these patterns that are created during certain market cycles. And then you can compare those patterns to the cycle we are in. They will also give you an indication of a potential move that is coming. So there's Fibonacci sequences, there's all these things that you probably saw in math. There's also what I call the genetics of the markets themselves. So you've got a hand here, and you could say, the bigger the palm on average, you're going to have longer fingers, right? So when we see this first move that we've come out of the bottom here, the companies created these patterns or these fractals that came up and pulled back. The size of those fractals, in my opinion, will probably tell us what the third leg that's coming could be in a lot of these different stocks. So the bigger the fractal, the bigger the genetics of this move, the ease of how fast this went up and pulled back will be an indicator of what could come next. And I don't think a lot of people, they may or may not know that. I'm sure a lot of technical analysis guys do. They do like Fibonacci extensions and all these different things. They're really just using, quote, a fractal or a pattern that's known and extending it outward to see what the potential move could be coming up. So I think I'm pretty good at knowing where the value is and then knowing the best vehicles to play it, using those fractals in the analysis and the technicals. So you've got, if you want to be an exceptional investor, you have to know a couple of different things. You need to know how to value assets and what's cheap, because that'll save your bacon if you're buying everything that's cheap. You're not buying expensive, in favor, we'll call it, assets that are expensive. And then the second thing is, how do you play it? So you know a sector's cheap. What companies do you use to play it with? What's the best risk reward? And that is, I think, incredibly valuable for especially retail investors, because what they do is they pile on the risk, and they may continue to pile on risk even though the rewards are declining to, so they asymptotically approach some level. And it's like, you don't need to be out here with the risk if you could be all the way back here, if this is risk, and get a return that is just slightly lower and have way less risk. You want to live in this section over here where you've got the least amount of risk and the most amount of reward. And that is where I think a lot of people screwed up. I'm really good at choosing low risk, high reward, and allocating my portfolio in a way to capture the best returns with the least amount of risk. And I do go out on the curve to try to get some swing for the fence type stuff, but I allocate in a way that I think will work quite reliably and capture the move in this bull market.
Totally. Yeah, very good. Another edge that I think the average investor, or just, even myself, have is just our position size. So that is, don't go all in on one thing, but invest small in a lot of things. And that way you can kind of protect yourself from, protect yourself and your own psyche from staying up at night, checking your phone, when the Aussie market's open or something, like, oh my God, I have like 70% of my stocks in Bannerman or something. But what sort of rules do you have in terms of your position? Do you have any rules? Like, in terms of the way you allocate sectors versus equities and so forth?
Yeah, so it's nothing like hardcore or anything. What I do is I put a certain amount in it, and I look at and see how it's, basically where we are position wise, like ratios, market conditions, and all that stuff. I'll add some in, and then I literally do like a gut check, and I'm like, do I have enough in here? No, I don't. And then I put more in. And that's literally what it is. It's not, it usually ends up in a 5 to 10% is a pretty good position size of what I put onto something. So it's between 5 and 10%, but it's not like a calculated bet. It's not something where it's derived from like math, or, I have a certain percent here, a certain percent here, a certain percent here, because it always changes. Where if I were to look at something and you say, okay, oil is at 101 ratio. We are down in the boonies here in terms of the pricing of oil. I might start sizing these things up massively in that type of market condition or environment, where it's like, man, this thing is so cheap, but your risk goes up because some of those companies could go bankrupt. So it depends on the market conditions, depends where we are at in the cycle, and it depends on what sector looks the best and how I'm going to allocate to it. If something is cheap and it's ridiculous, I might put 60, 70% of my equity portfolio in a certain sector and ride it. And that's kind of what I did in the beginning when oil was super cheap, oil and natural gas, because they were just off the chart cheap. And that just, I've never seen it that cheap before. So I said, screw it, I'm going in. I made a lot of money in that bull market of oil and natural gas, like life-changing money. And that's going to happen in certain sectors at certain times. That is what's going to create the difference between a regular investor and someone who changes their life. Like, you need to know when things are out of whack and cheap. That's generally when people are very fearful. And that's the time where, if you're going to go big into a sector, you go big when there's the least amount of risk. And that's when everybody's selling stuff and it's fear. There's fear in the market. There could be an event or some sort of event like COVID or something like that, and it just drives everything down to the ground. And that's when you go big. But you have to know when to go big and when not to go big. And that's where you're going to make a lot of money. So I don't want to say that I won't, like, I have some allocation strategy that's like that just works, irrespective of the market conditions. It's not the case. My strategy and my allocation will depend on what's cheap and what's expensive at that time. And I will reallocate if something gets expensive to something else that's cheap continually. I'm not saying every month, I'm just saying I'll continually do it over a couple of years. Right now in the market, there are some very cheap sectors. Gold and silver mining companies are incredibly cheap. They're getting close to breaking out. They're getting close to what I would consider could be life-changing gains coming up in the future if we can get a break here. What that takes is a fear in the market or changing of market conditions where people get scared of the currency, they get scared of the banking system, something could happen. And we'll see that kind of work its way higher. We've got gold, silver, we've got platinum all sitting on top of trend lines and breakouts. The setup's there. And gold and silver mining companies are incredibly cheap in relationship to gold. We also have other setups like uranium. Uranium equities are incredibly cheap to the underlying commodity itself. That could also be just incredible upside potential for uranium equities at some point. And what I do, I know a lot of people, what they try to do is they try to time the short term. What they're trying to do, and I'll just try to make an analogy here, is someone will say, I'll sell you a Ferrari, a brand new Ferrari that's worth, let's just say the market can do it for 240,000, but this guy needs to sell his Ferrari today, and he doesn't care what he gets. And he goes $30,000. And you're like, if I can sell this for 240, sure, I'll buy it. But what they're trying to do is they're going to say, no, I'm going to hold out until he gets down to 25,000. It's like, dude, it's so cheap, just go for it. That's what I do. If something's cheap, I'm going to buy it. If it gets cheaper, I'll buy more. I'm not going to let that valuation run away from me. I'm not going to let it, move up 100%, double, and be like, crap, I should have bought it. I continue to, I cost average in. I get my shares. If it gets cheaper, I'll buy more. Yes, it's cheap now. It's a great value today. I'm not going to let that valuation run away from me. So I'm going to buy it. I'll buy more if it gets cheaper, and then I'll ride it up until that valuation changes to an expensive state. So I'm just going to say to most investors, that's just my strategy there to some degree. I don't think that you can time the short term to the degree that a lot of people claim they can get. So I think we should focus less on the short-term volatility, like in terms of days and months. Yes, these patterns do form. Yes, we try our best to get the cheapest prices, but no one's going to be perfect. And if it's a very cheap price and it's starting to look better and better, I'm going to start firing off buy signals. So that's firing off buys, not buy signals, but buys. But yeah, that's how I play it. It's nothing too extravagant. It's nothing too precise.
Yeah, it's the age-old accuracy versus precision argument, right? You don't want to, don't try and get like too many significant digits out there. Just try and get it generally right.
Yes.
The Lamborghini's $30,000. Go ahead and buy it. Don't worry about it going down to 25. Great point. So you mentioned gold and silver miners being underpriced relative to the metal itself. So I had a question from one of my followers on Twitter. Anytime I have these interviews set up, I ask my followers for a couple questions here and there. And one of the questions was, do you see the miners, do you see a scenario where the miners lag behind the commodities? It could be gold and silver, but just generally speaking, last year we had the nickel price shoot up, but the nickel miners were kind of, didn't really move at all. So is there the potential for gold and silver miners, uranium miners to kind of exhibit that same behavior? And why would that be the case?
Yes, we've seen it in the past. We saw the last bull market in the 2000s. The gold and silver mining companies did well in the beginning of the bull market to 2004. And then after 2004, all the way to 2011, the physical metal outperformed during that time frame. So what I'm looking at is I'm looking at like an XAU to gold ratio to actually break its downtrend to give me some sort of positive signal that yes, we're breaking out here. And what could happen is that short-term fears in the market drive gold and silver to levels faster than inflation. So the market condition that we're looking for that to work in is actually your gold and silver mining companies in relationship to the consumer price index. So it's basically gold and silver outperforming other commodities during a certain time frame, and that outperformance will drive the mining companies' margins. And that can happen, and I think it very well could happen if energy gets constrained. Energy prices will go up, but at some point, I think people will fear currency problems, and it'll rocket ship the price of gold and silver to a very high level, like it did in the 1970s. It may not be the same exact. Well, it could be the same exact reasoning. Is they get scared of the currency or the bond market or something like that, and a major amount of money wants to shift into something different. That could cause the gold and silver mining companies to really take off. But there can also be scenarios where the ore grades are really low and it gets very difficult to mine a lot of the actual physical commodity. And the mining companies struggle because of their input costs. And the costs of the inputs continue to rise, increasing the commodity price, the bottom of the commodity. So commodities get priced off of the cost curve of the high cost producers, and then whatever demand, if there's a supply squeeze, it goes way up and bounces off that cost curve. The cost curve could continually go up, increasing the price of the commodity, where the mining companies underperform and the commodity price outperforms. That's also a probability of happening. Which one's going to happen? I don't necessarily know, because it depends on what the market, like the market conditions and what they do in the short term. If we get a scare of the banking system and people just pile into gold and silver, the mining companies will go ballistic, I think. But if it's a long-term, drawn out, where you never get that fear in the market, gold and silver will go higher, but it's from inflation, and your cost curves will just continue to go up and up and up and up and up from declining ore grades and increasing energy costs. That's where your commodity will outperform. So in my opinion, what I've done is I've got a gigantic lump in the physical commodity itself, like physical metals, stuff like that. Your risk reward, because the risk is so low, is very good. The mining companies, your risk goes way, way up, because there's so many things that could go in the opposite direction of what you think they could go, and you could miss the bull market in the actual commodity itself. Their mine could get nationalized. There's taxes, bad management decisions, problems with the mine. They've got supply problems for creating the mine, XYZ, goes on and on and on and on. I mean, there's literally thousands of things that could happen: earthquake, flood, etc., etc., etc. When you own the commodity itself, that's generally what everybody wants, and that becomes pretty easy of a play, because you buy the commodity goes up. Yes, I made money. It's that easy. So yes, there's scenarios where the mining companies could do incredibly well. Yes, there's a lot of scenarios where the commodity or the mining companies are going to underperform the commodity. I don't necessarily know which one's which. I'll say this. I think the commodity itself, playing it straight up, is a much easier play, much less risk. And that's where I would dump a lot more money if it were me. And that's what I'm doing. That's how my strategy and how I've positioned. If you were to look at it from a percentage basis, I may have 20-30% of my net worth in physical metals. And that is extremely high compared to what most other people would consider as an allocation. I have probably got 30-40% or something like that allocated to equities, and the rest is real estate. That's kind of how I'm allocated. And in that portfolio of allocation of the equity side, I've got a lot of what I consider to be cash cows Those are companies that generate cash flows. And then I've got my speculative positions, which are even smaller in that, which are companies like uranium companies, some of these gold and silver junior companies and stuff like that. So that's a smaller percentage, very small. I've got big cash flow like royalty companies, oil and gas companies, ones that are generating cash, fertilizer companies, ones that pay dividends. And a lot where I think a lot of people get wrong is they just go pile into the speculative little junior companies that make no money, have all the risk in the world, expect them to just moon, and then they don't. And it's like, you just blew your opportunity in the commodity bull market on a company that didn't really have a chance.
Got too greedy.
Well, yeah. Well, I don't know if it's greedy or if they don't understand the risks that they're taking. I don't know which one it is. I think they don't understand the risk for the most part. I think if you were to say, you know what, there's a lot of companies with, like, I'll just make an example. All right. So the reason I went so big into oil and natural gas at the bottom of that market, they had infrastructure in place to generate cash. So if you look at 2013, 14, these guys were generating billions of dollars in cash flow per quarter. And I could buy that company that could generate multi-billions of dollars in cash per year for 180 million market cap or 150 million market cap because the oil price went negative. The problem with the speculative junior company in uranium or oil or whatever is they don't have anything to generate cash. They have to build it from scratch. They have a piece of land and they have to build it. That is way, way harder than me buying a company for 150 million market cap that was generating $2 or $3 billion of cash flow per quarter in revenue, or I should say revenue. And I could buy them for that price. Now I'm just playing one big leverage play to the price of the commodity at that point. They can generate the cash. The infrastructure's there and the management team's done it before. It's all in place. I just need the commodity price to come back. Those are the situations I want to look for. Other people, and that's especially retail, they want to swing for the fence and take all the risk in the world. And it's like, why would you take that risk? Find a company that's blown out or that's very cheap, buy it because the cash flow is there, ride this commodity bull market up, and these guys will be making, just monster amounts of money. And they've come out and they're like, we're going to buy back our shares. We're going to pay you dividends afterwards, after our debt's paid off. I'm like, that's perfect. You've got this vision that they've created that says they're going to reward you if you stay with us. Now, what are you going to get from a company, a small junior mining company, that's going to continue to dilute you to some extent? What are they going to promise you in the future? Nothing. They have to build the mine. Then they have to get all of these trucks and infrastructure, steel, copper, all these things which are going to be in short supply. So one of the ways that I think you could play this bull market, if you want to de-risk the portfolio, so to speak, and you still want to take on risk and try to get the leverage, find companies that are mispriced, that have the infrastructure in place, and that infrastructure, in my opinion, will be a, quote, moat in the future. Because as things become more expensive, the ability to recreate that mine in a different location is going to be very costly. So I think that a new mine that came into place recently that has a lot of growth, that has all the infrastructure in place, could be a pretty good bet, because the infrastructure is paid for, it's in place. They're basically mining it. They're getting cash flows going. And if the commodity price really takes off, I think you're in a pretty good spot to benefit from that. And I think you're de-risking it now, so to speak, and they can figure out how to navigate the future market with higher inflation. But I think some of these new companies that are going to have to build mines some years out, it could be pretty costly. And the infrastructure in place will be very valuable at that time. And I think a lot of people are playing the offshore drillers in that way. What I called it before is the embedded energy. So these gigantic structures that are created in deep sea drilling, the drill ships, the infrastructure, the floating, whatever they call it, pads or rigs, it costs a lot of money to build those things, and they are very commodity intensive. If you already have a bunch and they're already in operation, I think in the future, if oil gets pretty expensive, you're going to see those go up in value, and you're going to see the day rates go way up. So that's one sector that looks really, really good, is offshore drilling companies, because of the embedded energy and the time and cost it's going to take to replicate those assets.
And they barely moved too. Like,
What's that?
I don't know if, and they've barely moved,
Mhm.
like as of right now. Like they're, I was just looking at them relative to a bunch of other
Mm.
commodities, and they're some of the cheapest out there. So totally think, you're
I've got some
on the right
big
track.
positions in them. I'll just say
Yeah.
that.
Yeah. Nice.
Mhm.
Well, thank you so much for coming on, Andy. This was a
Mm-hmm.
fantastic interview. I really enjoyed it. We got a lot out of it. How can people find you? And any closing thoughts before we sign off?
Yeah, they can find me at, you can find me on my website, finding-value.com. You can become a member there if you want to join our community, or you can look in Finding Value Finance channel. You can find me there as well. And then closing comments, all I'll say is be careful how much risk that you take as a retail investor. It's not about swinging for the fence and hitting home runs, because you strike out a lot. It's about trying to find the fat pitch that you can hit, and that you can hit reliably, and maybe you can hit it out of the park, maybe not. But if you're getting on base every time, that's where
Singles
it
and
counts.
doubles. Singles and doubles.
Yes, singles and doubles, and sometimes you hit some home runs. That's perfect. And if you really want to become a good investor, you have to be able to identify when the opportunities are there, and then you got to size up those positions correct.
Execute. Yep.
If the opportunity's there and it's cheap, well, you need to know when to go big and when to relax and not go as big. I do think that some of those opportunities are out there still, where things are very cheap. We're just waiting for them to improve a little bit, start to come off that base, and it's like, ooh, here we go. So they're out there.
Fantastic. Well, thank you again, Andy. It was a pleasure having you on the show. If you guys enjoyed this interview with Andy, click the like and subscribe button on this video and on this channel for more interviews and content like this. And in the meantime, have a good one, y'all. I'll see you next time.